We're all going on a summer holiday for me and you. You do. Oh God, shopping again.
We're going on holiday, it's necessities.
You're right, we are going on holiday. Going on a cruise this week. And, well, I think Winky's working out what the Titanic is because she's sinking my bank account at this moment in time.
A couple of jumpers is not going to sink your bank account.
Trust me, it won't be a couple of jumpers. I've seen the way you shop.
How?
What? Well, the running joke used to be your next bill was bigger than our mortgage. And that's when we had a big feckin' house.
Problem?
Yeah. No wonder I'm bald and bloody stressed to death.
What am I supposed to wear?
Nothing.
Oh, that'll look well on the ship, won't it?
Damn right it'll look well. Oh, look well with me. Oh, sorry, boys and girls. We're excited today because it's holiday time again. And it's also review time. What I'm going to do is I'm going to review the small account, but I'm also going to put a twist on it.
Matron, take them away.
And a warm welcome to one and all. This your first time here? I'm the big fella Scruff, and sitting next to me is the wild wonder Wink, who I often wonder if she lives on the real planet. Because you bloody hell!
What? I haven't done anything. I haven't
I'll
pressed
just
the
say
delivery
now.
button.
No, she hasn't pressed the button yet. But bugger me. Let's put it this way: there ain't a van coming to the house. Again, woman, just as well I love you to bits. But I love my job. And for those of you who have come here just from sort of thumbnail title, Easy Vanguard, let me tell you a little bit what my job is. I am a trader for a living. I trade the currency markets, indices, and commodities. And I do that through a form of day trading. And if you follow any of the other videos on the channel, you'll see that apart from these sort of coffee with scruffs, there is a lot of me trading at my job where I predominantly show day trading. Now I also do what's called swing trading, where it's a longer term trade. And then from that, I also like to have what's called passive income or passive investments. And that's where Vanguard comes in. Now, there was an account that I set up in December where one of the guys in the Discord, the squad that I run, asked what I would do with £100, and it was a bit of a head scratcher. And I put £118 into a share account, and over the course of this year, I've built that up and transferred the funds from that share account now to a Forex account that I can sort of day trade because I've built it up to a level that I was able to, because I've got to trade on margin and various other things if you don't understand what that is. But do check the other videos out and you'll kind of get up to speed on that. Now, what I also wanted to do with that little account was use it for longer term savings or longer term investments, and that's where Vanguard's come in. Because having run businesses for, well, in excess of 25 years now, you shouldn't have all your eggs in one basket. You should diversify your portfolios, high risk, low risk, medium risk, so it spreads out what's going on. And that's why I have multiple trading accounts, because I don't put all my eggs in one basket. So why I don't have a single bank account, I have multiple bank accounts, etc., etc., etc. So let's cut a long story short. Where's Vanguard come into this? Well, Vanguard is a very easy way to invest. And it's a very simple setup. It's quite cheap. And this isn't sponsored by Vanguard by any means. Although if you are watching Vanguard, I am open to sponsorship, because why not? But I do like the platform and I like the simplicity of it. So what I'm going to do is I'm going to show you what I've done. Now, I also trade prop. Now, this is with a company called the 5%ers, and If you're interested in prop trading, it's where a company will essentially put the money up to market. You trade it and you have a profit split. It's a very simple process. There's a small buy-in fee, which you use to open up your account, and away you go. And your return on investment is massive if you're looking at the long term. And one of the beauties of the 5%ers is there is no time limit. In the prop industry, there used to be time limits where you had to do 10% in 30 days. I was never a fan of that. Well, I'm not a fan of the prop industry full stop, but I am a fan of the 5%ers because they genuinely put the trader first. So that's why I stick with them and I still trade with them. So where are we going with all of this? Well, let's go back. Let's show you a couple of spreadsheets. I'll give you the update, but then I want to show you what I've done with Vanguard and how the 5%ers has played into that. So first of all, there's the share account. Okay. If you look at the summary, you can see in April, my tax year goes April to April. That's why this is out of kilter, by the way. But it started 118 and it's increased to the April balance, which was here. Now, I was dealing with shares at 10 pence a share, and I was sort of swing trading this on what's called the river. Okay, the river is a system that I use, and it's on daily charts. Oh, talking of river, she sailed off down the river. Oh, I see you've hit the basket.
I've got nothing to say.
She's got nothing to say.
I'm prepared to.
Well, it better be a nice treat this weekend if I'm coughing up for that bill. Right, anyway, sorry. The river. The river is just a swing trading strategy that I use, and it's battle tested and it works. And how do I know it works? Because you're looking at it right now. So, but because it's like 10p, it's a pound here, it's 50 pence there. It doesn't sound a lot, but they all add up. And anyway, it added up to a point where I could trade gold. Now, gold is a relatively cheap commodity, which meant I could put a little bit more money on. Instead of 10 pence a unit, it was a pound a unit. So instead of getting a pound in return from a 10 pence, 10 pip move, I was getting 10 pounds. Adds up, adds up, adds up. Anyway, my aim was to get this to £1,000. Now, I'm there a bit earlier than I thought, you know, because the markets have been pretty good over the last few months. And now what I'm going to do is I want this account to grow so that I can increase position sizes, but I also want something in return. So what I'm going to do is I'm going to half the profit each month. Now, it came into it sort of this month, so it's essentially going to start next month. So 1st of September through to October. Whatever I get there, I'll half it, and the halving is going to go into Vanguard, and then I'm going to use Vanguard for long-term passive income, or long-term passive investment rather. But I'm also going to contribute so much of what I get from the 5%ers. So what have I done? So this is the state of play where I'm at. You can see it's a fantastic equity curve. You can't sort of get away from that. And if I just pull up what the 5%ers give me, you'll sort of see a little bit of how they pay me. So this is a deal account. Now, deal account is where they dump their money, and you can just transfer to any bank account. So as you can see, it's still running. Every month they pay me quite a reasonable sum. It's anywhere from sort of £500 to £1,000 a month plus. Okay, so I'm happy with that. I'm really happy with that. So I'm going to take half of that, roughly about 500 quid a month, which I can live with. Okay, and then if you want to see sort of the equity return of that small account, there's the equity small account over the last sort of 30 days or so. So it's growing fantastic as well. You know, and you move it up and it kind of shows what's going on down here. You know, it's up and down, but my rate of return is good. My win rate of picking out the right stock and the right product is good. I'm really happy with what's going on here. You know, likewise, I'm happy with what's going on here. So where does all of this go? Well, I love spreadsheets. I live on spreadsheets. So I've made myself a little investment spreadsheet, which is here, and I'll put one in each year. And at the moment, you'll see that there's some categories down this side. Now, I've only opened this up the other day, and I dumped £2,500 in. But why £2,500, I hear you say? You're only making £100 off the thing. Well, I've just shown you the 5%ers, which is approximately sort of £1,000 a month, give or take, you know, on that particular fund. I want half of it, 500 quid. Well, April, May, June, July, August, 5 months, 500 quid each. I've withdrawn 2.5 grand, dumped it into the Vanguard, and then from October, I've also opened up a SIP inside that Vanguard, and I'm going to put the profits of that small account into the SIP. And what's a SIP? Well, again, it's just a good way of getting tax efficient because you will get your tax back. So if you put £500 into it, the government will give you 125 quid back, or thereabouts. You know. So let me show you Vanguard.
Well, we're waiting.
So this is Vanguard, and what you'll see here is there's the 2,500 that was put in, but it's got 65p on the end of it. But I said I only put 2.5 grand in. So that's because it's already growing, and that can be seen there. You know, it's not a lot, 65 pence, but it's 65 pence in one day. And I've split this up. So this is the ISA. It says it's got 12 pending transactions. That's because I've gone through various bits and pieces and I've set it up where I will have various things. Now here, if you see, it's on the 1st of the 10th. There is sort of money set up to go into the pension side, the SIP. That's from the earnings of the small account. Now I can change this whenever I choose. Just click edit, and then down here you select what you want, blah blah blah, what date it is, etc. So if I have £200, I can add it into these things. Now I'll go through what these life strategies and things are as well, because they're quite important. So we'll click this back, just exit that, just so I can get back onto there. Right, so there's the portfolio, pension, but we're going to concentrate on the ISA side. Why the ISA? Well, for the UK, it's tax-free savings, but there is what's called general accounts in Vanguard, which works the same, but then you'll pay whatever your prevailing tax is. Okay, so how do you operate around this? Well, it's a very simple website. This is your overview. Gives you an overview of what you've got, and it's telling you how much my ISA I'm allowed to put in tax-free, what my largest fund is, what my return is, available cash, etc, etc, etc. Right, so from here I can go to my investments. These are what I've bought at the moment. So I've got 20% of the fund in the FTSE, I've got 30% in the S&P 500, the rest of it are in cash. However, when the markets open next week, this cash will then start looking at adding into these funds here. Okay, so these will get some allocation, the German and the life strategies. Now, if I'm going to put an investment in, and I'll drop another one in now just to show you how it works, and I'll set it up for October. So we'll put £50 into a portfolio, and I'll show you how that works. What you need to do is you sort of figure out how much your budget is each month. Now, if it's just 50 quid, just put it in. But I prefer index funds where I don't want them what's called active. Let me show you. It might make it easier to show you. So if you go, what do they offer? And it's a full list of everything they've got. And you pull this down. The fees are relatively cheap, you know, and it'll tell you what the ongoing charges are down here. 0.22, etc. Anything under 1% is fine, in my eyes. Now, what you can do is you can look at past performance to see how well the fund has performed over a given period of time. It's normally the last 3 or 4 years or 5 years. Or you can just look at how it's built up. Now, when you're looking at a life strategy fund, it's where they will put in a whole load of different options under one banner and then show you how it's made up. Well, it's made, this one, for example, is made up of 80% bonds, 20% shares. Now, if you're doing this over a very long period of time, you want it more weighted to shares than bonds. Bonds is what's classed as very safe investments, but the return is incredibly low. So as you get close to retirement, if that's what you're using this for, you would then go from high yield shares into low yield but safe bonds, because you haven't got time to ride out any noise. But if you've got a long period of time, have the weighting the other way around, because if the share market has a bad year, it's not a bad thing, because it just means you can dollar average into it or pound average into it, get more units while it's cheap, and then when it recovers, it'll have a bigger return. Now, this is something that I use very similar in my day trading. I call it Scruffy Madness. It's the same principle on a micro scale. Something that I've done with my business. So when we look at these are very good for set and forget. Now, I have 2 of them set up. I have one that is 100% shares, and I have another one that is kind of an 80-20 split, 2 shares. Sort of, these are the 2 that they are. Okay. Now, the risk levels are 5. So the kind of up the scale a little bit, but the returns are better. Okay. And then you'll be able to see the returns here. So if you go past report performance, come down. In the last 5 years, it's only lost 1 year on the 100%, but it's grown reasonably well. And again here, all right, even when it had a blip, it's not that bad. So across the period of time, it's made decent money. So how would you navigate all of this? Well, they've got 86 funds that you can use, which are made up of these sort of ready-made. They're also made of ETFs, EGNs, etc. So the first thing is, you want to kind of establish what your tolerance for risk is. Mine's relatively high. So I'm sort of 4, 5, and 6. Okay. Now what that does is that filters it down to 75 funds. Okay. Because what you got to remember is everything that you do has a risk value to it. Now, because I work in the markets, I've got a reasonable idea of what I'm looking at. So I'm reasonably okay with taking on risk. If you don't know what you're looking at, stay middle of the ground, you know, sort of 3 to 5 along those lines. All right. But ideally, if you just want to drill it right in, just go bang in the middle, number 4, and then you're balanced, and then take it from there, sort of thing. So I'm going to leave them on, and we're going to take out 4. Okay, now we've explained that because there's too many to look at. Now, the type of markets that we're looking at, you can either look at active markets. Now, an active market is where there's a fund manager, somebody who actually sits at a desk and tries to outwit the market. Well, I've been in the markets 19 years. It was a former part of my job, which has then become my full-time job. And I can tell you, outwitting the markets is hard. It's really hard. So I don't want that. What I want is an index where it just follows basically the market itself rather than somebody picking it. So we're going to click that. And then what we're looking for is, at this moment in time, you can either have income-based investments or accumulation-based investments. Now, it doesn't matter which way you go, But if you go on accumulation, if your fund makes £10, it puts the £10 back in the fund and eventually compounds up. If it's income and distributing, what it'll do is it'll pay you the £10 and then you decide what you're doing with it. Okay, so that's what they are. And then when you come down here, it's just whether it's UK, whatever. Now at the top, we have various funds that you can deal in. Now, you might be really interested in emerging markets. So you click emerging markets, just like so. And what it'll do is it'll filter that down based on the filters down here to just a couple of funds. Nice and simple. But you might be looking at global funds. Now this is where all of this comes into place. Now the target retirement is exactly what it is. You pick the year of your retirement. So if you say 2055. When we was talking earlier on about this sort of weighted to stocks and a little bit of bonds, these do that for you in the sense it has a sliding scale. The closer you get to the retirement point, it takes the shares to the other side and increases the bonds. Do I use them? No, not really. But as we come down here, you then start seeing a lot of these, and some of the returns on these are exceptional. There's one there, the developed world for the UK FTSE, because the FTSE 100 does have a lot of investment overseas. It is returned fantastic. And then you just come down and you can see what it's done. And you just pick a fund that suits. Now, as you saw with mine, I had multiple funds because I'm going to spread out the risk. And then I'm going to show you a little bit why as to what that is. Now, there was a saying, and I can't remember who said it actually, but it was, don't look for the needle in the haystack, buy the haystack. And that's why maybe investing in the S&P 500 is good. At the moment, the S&P 500, and I'll show you in a moment, has performed every year. Every year there's been a return on that. Because instead of looking for the one share inside that top 500 companies, you've got them all. So if the whole index moves, you're doing well. So let's have a little look here. So that is there. This is something that I think is excellent, and I actually have that as a fund. But if you go to fund details, it'll start telling you all about what the fund is you're going to invest in. So at the moment, a unit price is £66. There's 506 stocks in it. That charge is nothing. And it has a risk factor of 6, but it's performed every year. Now down here, it'll start telling you all about what the fund is, etc. And there you go. There's your performance. Now, when I'm saying I'm looking at the markets, there's certain things that I will look at. So I will look at the structure point. Now, this is coming up to a high point. So as it gets to a high point, I'll build that fund up. But then I'll probably sell half of it and stall it just in case it moves up, and I'll watch for it to come down, and then I'll reinvest back down here. And this is why I have multiple pots, but this is my own way of doing things. To give you an idea, runs up, hits a high point that I can establish. I do things through Fibonacci levels, various other things. Follow the channel, you kind of see it, but it'll be done on monthly and weekly charts. So I'll still be holding these for a long time. When it comes bashing back down again, I'll just take the foot off the gas a little bit. But as it comes down, I'll average into it and then go back up. But I'll have taken some money into a different fund at the high of a peak. How do you find the high of a peak? Well, I like I say, I'll put predetermined points in using Fibonacci, etc. When it reaches that level, there's a high probability of a sell-off. At that point, I'll move the money into cash. So it's not coming out the fund, out of my sort of Vanguard. I'm just moving the money to a safer place while I figure out what's going on. and then I'll reinvest it back in. Nice and simple way of doing things. And then from there, that's it. And you get one of these on every single one of them. So just to sort of go through this again. 86 funds. Start working out what you want to invest in. You might have a good idea of what the UK economy is doing. You might have an idea of what the US, whatever, China, etc. start to come up. So you might be interested in emerging markets. So you can go, well, I'm going to only look at emerging markets. Right. So there's my emerging markets. I've got a reasonable tolerance of 5. What have I got? Well, I've got one market. That's all I've got. All right. But when I look at it, it's 97% bonds, 1% shares, and it's relatively safe. But there's the clicker. You know, it's just say made money. So is it an interesting market? Not particularly. Okay, so you kind of discount that. Then you can look at these things and sort of open it up a little bit. Go, okay, well that one's a bit bad. What about these? Well, there's the FTSE. You know the FTSE if you're English because it's in the news all the time, etc., etc. Is any of these any good? No, not particularly. So discount that. Go global. What's global got to say? Right. I only want indexed ones, and I only want accumulation. So I've got 13 funds to look through. I'm not interested in any of the life strategies or the targets. So that comes down to here. And then again, there's the all cap. Very good fund. Performed incredibly well. Again, global all cap index accumulation from the FTSE. Superb. Hardly lost money over the last 5 years. This one has never lost money over the 5 years. Excellent. Well, let's have a look at this. Let's see what this has to say for itself. Well, it's quite a high fund, so you'll have to save up a unit. It's got over 2,000 stocks in it. Fees is minimal. And it's constantly performing, but let's have a look at the chart to show us exactly how it's performed. That's a good equity curve all the way up. So that's a nice market, and from its inception all the way through, there you go. So we can invest in this. So click invest.
Good job.
And then you just check to make certain that you've got what you want. Continue with the purchase. And that's your lot. We done. Invest now. Into the ISA. Continue. What are we going to do? You can do a single payment, add in more investments. You can do whatever you want with this.
No way.
So basket, continue to purchase, ISA. Next available price. What I will say about these next available prices is if you want the price now, instant, there is a charge of $7.50. If you go next available price, it will just look at it. I think it's twice a day. It'll go say at 11 a.m. That's the price. That's what you get. But these are long-term investments, so it don't matter. You know, and say you want 50 quid into that. Next. There it goes. 50 quid, payment method, and then just whatever your debit card is, away you go. I'll not put that in because obviously I don't want you to see my bank details, but it is literally as easy as that. Or you just add it to a regular payment. Easy stuff, guys. Easy stuff. So what was all that babble about? Well, it's about just moving your money from one side to the other. In other words, taking it out of what is essentially your income into investment, and then just let it grow. Let it grow into something that's worthwhile. And what I'll do, just based on the comments below, is I'll update this on a monthly basis, and you can kind of see how the investment grows and whether these pots are actually making any money, yes or no. Let me know, and I'll do that, and I'll try and streamline them into sort of just little videos of, well, there you go. You know, this is the investment, this is what the pot's grown, and this is what I'm looking at this moment in time. Happy days. So if you're stuck, I'm very easy found. You find my contact details down below. And if you're interested in trading of any sort, do check out the Discord group. We're at it every single day. We have Zoom calls every day. And this is what we do. You know, we try and make our lives a little bit better. So as always, guys, trade well, keep your risk managed, but above all, do what you love, and the money will follow. See you all in the next one.